Hey, today we are going to talk about the one big beautiful bill and how this new law is going to impact your retirement. This law is really extensive. It has more than 800 pages, so maybe I'm missing some things in this video, but I'm going to try to summarize the most important for you that are thinking about retirement or maybe you're already retired. The first one. Many of us were thinking that in 2026 there was a sunset and the tax brackets were about to go higher. The highest tax bracket will be in 2026 around 39.6%, but now they are going to stay the same as the one we are having right now. So the highest tax bracket is around like 37%. The second thing will be the standard deduction for you to know, like most of the Americans are using the standard deduction. Almost like 90% of us are using the standard deduction. And so in this case, for 2025, the standard deduction was around like $30,000 for a couple filing jointly. It's going to be upgraded. It's going to be around 31,500. So you're getting like 1,500 more there, which is something really good there. And also, if you're remember that if you're over 65, you're gonna be able to keep optimizing this number because each one of you, if you're over 65 and filing as a couple, you're gonna be able to keep deducting like 1,600 per each one of you. So the final number, if we add all these numbers, will be that a couple that is over 65 years old is going to be able to deduct more than $34,700, which is a lot of money there. We also going to have a new deduction. If you're over 65 years old and you're producing, your income is below $150,000, you're going to be able to deduct $6,000 per each one of you. If you're filing jointly as a couple, this will be around like $12,000. And this provision is not going to last forever. I mean, after 2028, you're not going to be able to keep reducing or deducting these $6,000 per each one of you. But it's going to be something really good because if we keep adding all these numbers, because before we already have like 34,700, and now if we add these 12,000 here, maybe your deduction could be around like 46,700, which is a lot of money. It's $46,700 here. So this opens the opportunity for rough conversions or maybe some R&Ds, that you can analyze for these years. Another good news that we have here is the state and local taxes deduction. As you know, that amount is limited to $10,000 currently, but with this new law, it can go up to $40,000, which is going to be really good if particularly you live in California or maybe New York and you want to just keep optimizing your taxes. And instead of using the standard deduction, you're going to use some itemized deduction. And particularly, this is something really good if you already have a big mortgage and you're paying a lot of interest. And maybe when you add all this number, maybe you're going way beyond that standard deduction, which is going to be something really good. Another good information would be about estate taxes here. As you know, the lifetime exemption is around $13.99 million. But there was this sunset that was coming, and maybe that number was about to be reduced in half. So the good news is they are not going to reduce this number. It's going to still be like that. So there are a lot of good opportunities for you to not to be worried about maybe state taxes. Also, the child tax credit, which is something really good here. You're going to be able to use instead of the $2,000 that we already were having there, that amount was increased to 2,200. So it's going to be there for just 4 years, but yeah, you can keep optimizing that child tax credit too. Another good news here is the creation of the Trump accounts. These accounts are especially for minors under 18 years old. Parents are going to be able to contribute up to $5,000 in those accounts. That contribution is not going to be, you're not going to be able to reduce your taxes for that contribution. It's going to be after tax money, but it's going to grow, and it can grow if you invested, of course, tax deferred. And if you use that money to pay for college, maybe your first home, or also for starting a business, that withdrawal that you're making is going to be taxed as capital gains, which are usually lower than income taxes. Also, another good thing is that an employers can contribute to these accounts. They can be able to contribute yearly per employee up to $2,500, which is something really good there. Another good news here will be if you're thinking about opening a health saving account, that we know that these accounts are really good. They have like the three superpowers. The money that you're contributing, you can reduce it from your taxes. Your money is going to keep growing tax deferred. And if the money that you're withdrawing is for a qualified expense, I mean, you're not paying taxes on that one. These accounts, like now, they're going to give you the option to opt for these kind of accounts if you just have a bronze plan from your Obamacare or Affordable Care Act health insurance plans, and you're going to be able to do that. And there are some new expenses that they are qualified, and you're going to be able to use them, as telehealth, for example, is going to be one of the ones they are going to allow you to use too. And one of the last ones for this video are going to be if you're thinking about buying a new car and that is made here in the US and you're asking for a car loan, you're going to be able to deduct up to $10,000 of interest that you're paying on this car. And if you make as a couple less than $200,000. If you're thinking about buying a new car, as you know, most of the financial planners, including me, will suggest you to buy a used car, but there is that deduction there. I hope this video has been helpful for you, and if you need more information, please let us know, write it in comment, and if it was helpful, please share it and like it and subscribe to our channel. Thank you.